But today we are having this special discussion. A lot of people in the market are awaiting this event of one of its kind consumer tech IPO, which is starting a string of other IPOs to Zomato. Enough has been discussed about how the company is, and we need to scratch the point a little more, much more sharply, because a lot of people out there are weighing options whether to apply for this IPO or not. What are the risks associated, and how should one be analyzing this pocket in the first place? I have with me Abhay Agarwal of Piper Serica, who has looked at that space very closely, not just because of this IPO, but about 8-9 months. For 8-9 months, they've been working very closely on platform companies, internet-enabled business models, and how they are scaling up. CDSL, India Mart, Angel Broking, if I'm not wrong, Ease My Trip as well. Abhay, the list is long. You have worked on it, and I must congratulate you on your call in this one. But Zomato will be tricky, isn't it?
Yeah, thank you, Ajay, first of all, for having me. So yes, we have been looking at this entire space, companies that are using digital technology, digital models, and Zomato is right at the forefront of technology meeting consumer space. So it is a name that everybody is very familiar with. So unlike some of the other names that you mentioned, which are more on financial services like CDSL, Angel Broking, that have done extremely well, Zomato is a consumer product company, and the more we look at it, the more we believe that it will reward the long-term shareholders. But anybody who's looking at a quick flip or a quick bet may get some money. But again, since the IPO is not really cheap in terms of valuation, though the market size is very high, very large. So what we are looking at is a very broad target market, which is almost valued at close to $250 billion if you take half of the food consumption market in India. And then what Zomato and Swiggy are doing is just scratching the surface there. So if you take a 5-year view, and if you can believe as an investor that, look, Indian consumption habits will change with millennials and Gen Z ordering more, spending more on digital platforms, through digital platforms, then Zomato looks like a no-brainer for a long-term investor. But for a short-term investor, yes, it may be a challenge, to come to grips with the valuation.
Abhay, let's talk about the argument of the company not making profit right now, in fact, burning cash on one side. On the other side of, there's talk of that, the kind of runway of growth and the terminal value of these kind of companies, because you have analyzed some of the other successful business models globally. Where do you see this argument? So
I think, on the company making PAT losses, yes, it is making PAT losses, and that is why using traditional valuation metrics is very difficult for investors to get their arms around it. At the same time, you have to realize that these are tech services businesses that write off their entire investment. They don't invest in plant and machinery. So it was a manufacturing company, it would be depreciating its plant and machinery over 15-20 years and showing a PAT. Here, you are writing off every investment that you make pretty much in the same year. So the PAT looks negative, but I would say it's more of an optical thing. And the flip side is that with no big depreciation in future years, and as the gross order value increases, the AOV increases, the number of users increases, the company will become tremendously profitable. And we have seen that, I don't want to compare exact names, but you look at companies like Facebook or even Twitter now, or some of the other global giants, they all became profitably very fast once they hit a certain size. And that is where the target market size allows Zomato to grow over the next 5 years, because its earnings are driven by 3 metrics. One is the number of active users. The second is how many times in a month do they order. And the third thing is the average order value. Now, if these 3 things grow together, or let's say even 2 of them grow together, then you're looking at an exponential growth in the top line. And large part of that top line will flow into the bottom line, because the cost structure is such that assuming a standard take rate of about 20% and limited costs, you become very profitable suddenly. So as a long-term investor, I would look at that, and I think that's why some of these companies like DoorDash, Grubhub, or even in China, the closest proxy is Meituan Dianping. They are valued at what they are valued because they have shown that growth curve, the growth path they can get into. A lot of people don't believe yet that in India that is possible, but we believe that with the median age of 29 years, the youngest population in the world, we are headed in that direction. I don't think the future, the next generation is going to cook 90% of their meals at home. So as these things change, you will see profitability kick in, and taking a long-term view, we see Zomato at par with any global company in the same space.
Right. Abhay, how does the unit economics really work on this one? Also talk to us, in the way we analyze the listed companies, people say that the kind of returns one can expect would be on the back of the kind of earnings the company makes over the long term. What about this one? The earnings are not there. So what kind of, does the growth which the company is actually clocking in terms of acquisition of customers, does that indicate the kind of returns, or how does one gauge the potential returns over the next 5-7 years?
So great question. I think because you asked about unit economics, and that's a good way to look at it in a minute basis. So the earnings are driven by what are called average order value, AOV. And the AOV of the company has gone up in the COVID time because I guess lesser number of people were ordering larger ticket size. So the AOV, which used to be around 240 rupees, jumped to almost 400 rupees as of March 21. And the number of users came down. Now the AOV is very important number because AOV allows the company to earn the commission. So the take rate of 22%, which is what the company makes, is linked to the average order value. So higher the average order value, assuming the same take rate, the company makes more money per order. So right now, the revenue for the company from 400 rupees AOV is about 90 rupees. Now that 90 rupees then covers the cost of delivery. Now, as you do more and more deliveries, the cost of delivery comes down, cost per delivery. So we have seen cost per delivery fall from 65 rupees to about 48 rupees now. And as they do more and more deliveries, that cost will come down further. Then the AOV, then the revenue per order also covers the discounts that other than the partner restaurants, Zomato itself gives. Now in the COVID time, they really brought down the discounts from 20 odd rupees to 8 rupees. And the third thing are the variable costs, which are the marketing expenses and the likes. So for the first time, Zomato showed a order level contribution of 20 rupees per order. Now, will this sustain, or will the AOV come down as the market opens up and more people order, go back to office and start ordering cheaper meals? Because the delivery cost being the same, there is a school of thought that, look, if AOV comes down, then the company will again start losing money per order. That is not our view. That may happen in the short term, but in other countries we have seen that the order value is quite sticky. Once it goes up, people order more and more rather than less and less. With a 5-year view, you have to also build in the food price inflation. There is a normal escalation of order value that goes up. And the third thing is that the number of restaurants that Zomato has is only $148,000, which is the lowest in the world. I'll compare that to China's Meituan Dianping, which has 68 lakh restaurants. So you can see in India where we are in terms of evolution compared to some of the other markets that are ahead of us. Now, assuming we keep moving in the same direction, we believe that in 5 to 7 years' time, Zomato will quadruple to 5 times increase its gross order value. So if gross order value goes up from 12,000 crore to 60,000 crore, we believe the company will be making a very reasonable amount of profit on that. So once you take that perspective, work it backwards, and this business also has a very high terminal value. So even if you stop at 5 years or 7 years, looking at 10 years beyond that, the terminal value is still very high. So even if you do a DCF calculation, work it backwards, the opportunity looks pretty sizable.
Right. Okay, let's move on beyond Zomato then. Let's talk about the platform companies, especially the market ones. We are looking at, Upstox talking about a huge addition in their clientele, over 70% of them being millennials. We've seen what angel broking is doing. If you look at the angel broking graph, it is kind of just moving in line with the kind of addition they are doing every month or every quarter. Same is the case with CDSL. We just saw 4 crore accounts, and look at how the CDSL stock got re-rated over the. So how do you see these market-related tech companies, which are also benefiting from the bull run and millennials joining, owning financial assets?
So Ajay, the names that you mentioned are in the public domain. So we can see them, we can analyze them. We are very profitable companies already. There is also a very large segment which is still in the private space that will come up for listing sooner than later, like Policy Bazaar, Nika and all. But let's stay with, what is in the public domain, as you mentioned, CDSL. I mean, CDSL run has been breathtaking. We have this company in our portfolio for many years. The first 1 crore accounts were opened over 15 years. The second crore was opened over 5 years. The third crore was opened in 1 year. And now the latest 1 crore is opened only in 6 months. So, that is the power of digitization when the market moves in your favor. So CDSL got terribly lucky that there is a whole set of new investors who came in and they started opening their accounts with the discount brokers like Upstox, Zerodha, and more importantly, angel broking. And that created an ecosystem where angel broking and CDSL are literally working closely together to help retail investors bring down the transaction costs in a very transparent manner. And the trade volumes are very high. A lot of market is being seeded by the traditional brokers to the new technology-based brokers. I won't even call them discount brokers. I think that's a wrong name that people use. Just because they charge low because their costs are low, they don't become discount brokers. They are very profitable. They are more profitable than the traditional brokers because their costs are low. And if they're passing on the benefits to their users, that's great. That is exactly how all these markets will continue to grow. And CDSL even now at 4 crores of accounts is still scratching the surface of what is possible in terms of total number of accounts and traded volumes in this country. So we see this as a completely a secular run of growth for companies that have invested in digital technology over the last years and now are enjoying the benefits, growing very rapidly. Angel, for that matter, is the CEO, has a person who's a Google alumni, so they have realized that technology is more important than anything else. So they have figured out that there are ways to nudge the cohort of investors to get them to trade more. So I think all these companies are learning how the digital model works, how consumer technology works, and focusing on that. So we are very confident that this run will only accelerate. It will not slow down.
Right. All right, Abhay, always wonderful to get your inputs on my show. Thanks so much for your time today as well. Have a great day ahead.
Thank you so much, Ajay.